Morning, Jim. Morning, Ryan.
Morning.
Good morning.
Morning, Irene and Matt.
Good morning.
And it looks like we're at 9 o'clock. Looks like we have all the trustees that are in attendance right now. So I will call the investment committee to order. And I'm going to ask Ellen, if you don't mind, to take a roll call for the meeting.
Certainly. Good morning, everyone. Trustee
morning.
Bartholomew,
Yes.
Trustee Donnelly,
Here.
Trustee Irwin,
Here.
Trustee Gardner,
Here.
and Trustee Martin.
Here.
We're all present. Go right ahead.
Excellent. Well, good morning, everybody. We got a bright, sunny Monday morning, and like I said earlier, we've survived winter once again. Almost survived tax season. That ends tonight at midnight, and well, we're on the tail end of the pandemic, but things are looking bright. So what a difference a year makes. So I'm going to remind all participants to leave their mics muted when not speaking. And I'm going to introduce the first item. We're going to be going over our non-voting trustee members. The first couple agenda items are the resolutions for the non-voting non-trustee members who have completed terms, and then tab 3 and 4 for the appointment of new trustee or non-voting non-trustee members. So our first resolution would be for Peter Handy. Peter has completed his service as a non-voting non-trustee member of the investment committee, having served since September 25, 2017. Mr. Handy, a chartered financial analyst, came to us with a breadth of knowledge from his own business endeavors as president and CEO of Bristol Seafoods, and from his financial service roles at JP Morgan Chase and Company and Sanford Bernstein and Company, where his work ranged from asset management to institutional trading. The University of Maine and the Investment Committee extend sincere appreciation to Mr. Handy for his dedication and for sharing his knowledge and expertise. His thoughtful perspective has greatly enriched our discussions, and we extend our best wishes to Mr. Handy. So I'd like to read the text of the proposed resolution. That the Board of Trustees, acting through the Investment Committee, extends its appreciation to Peter Handy for his dedication and service as a non-voting, non-trustee member to the Investment Committee. Do I have a motion?
So moved.
So moved by Trustee Gardner. Second?
Second.
Second by Trustee Bartholomew. And I'll turn it over to you, Ellen, for the roll call, please. Not for the roll call, but for the vote.
You're on mute, Ellen.
Thank you. Trustee Bartholomew,
Yes.
Trustee Donnelly,
Yes.
Trustee Irwin,
Yes.
Trustee Gardner,
Yes.
Trustee Martin.
Yes.
The motion is carried.
Excellent. So our second outgoing non-voting non-trustee member would be Eric Hayward, and Eric's term expires in October of this year. So in October, Eric Hayward will be completing his second term as a non-trustee, non-voting member of the investment committee, having served since October 8, 2015. A chartered financial analyst and an executive vice president of the Libra Foundation, Mr. Hayward has brought a wealth of knowledge and experience to our discussions and decision making. The University of Maine and the Investment Committee would like to extend sincere appreciation to Mr. Hayward for his years of dedicated service and for sharing his time and expertise. His thoughtful perspective has greatly enriched our discussion, and we extend our best wishes to Mr. Hayward. I'll read the text of the proposed resolution. that the Board of Trustees, acting through the Investment Committee, extends its appreciation to Eric Hayward for his dedication as a service as a non-voting, non-trustee member. Do I have a motion?
So moved.
So moved by Chair Trustee Irwin. Second by Trustee Donnelly. And Ellen, I'll have you take the roll.
Certainly. Trustee Bartholomew,
Yes.
Trustee Donnelly,
Yes.
Trustee Irwin,
Yes.
Trustee Gardner.
Yes.
And it's
Trustee
I'm
Martin.
only going to exasperate. If
The
we
motion
go
is carried.
5 years, we'll say, why didn't we?
I was just at the bottom, and I have zero problem if other banks will follow us on this.
Just a reminder, everybody to keep their phones on mute when not talking.
Technology, what Paul said does.
There we go. All right, our third agenda item.
I just wanted to say, if I could, Kelly, thank you.
Oh.
Thank you very much for that resolution. I've appreciated working with the committee, and I've learned a lot from all of you. So I'm very, very thankful for that, and wish you all the best. So thank you very much.
Thank you, Eric. We've really appreciated your expertise on this board, on this committee. Okay, with that being said, I'll move on to item number 3, and it's going to be to appoint a non-voting, non-trustee member, and this one would be in Peter Handy's place. So myself and Chair Irwin recommend the appointment of Jim Bradley, a non-voting, non-trustee member to the Investment Committee. Mr. Bradley is a founder and chief investment officer of Penobscot Financial Advisors, with offices in Bangor and Portland. With $260 million in assets under management, Penobscot Financial Advisors provides comprehensive financial planning services to over 700 households, including advising many University of Maine system employees and retirees. A graduate of the University of Connecticut, Mr. Bradley is a certified financial analyst, an accredited investment fiduciary, and a chartered alternative investment analyst. He also serves on the board of Hospice Volunteers of Hancock County. So I'll read the text of the proposed resolution. That the Board of Trustees, acting through the Investment Committee, approves the appointment of Jim Bradley to a 3-year term as a non-voting, non-trustee member of the Investment Committee, effective May 17, 2021.
So moved.
So moved by Chair Irwin, seconded by Vice Chair Gardner. And Ellen?
Certainly. Trustee Bartholomew,
Yes.
Trustee Donnelly,
Yes.
Trustee Irwin,
Yes.
Trustee Gardner,
Yes.
Trustee Martin.
Yes.
The motion is carried.
Thank you. And our second appointment to a non-voting, non-trustee member, which has been recommended by Chair Irwin and by myself, would be Matt Scaves. Mr. Scaves is a chartered financial analyst. He's a chief investment officer at Deegan Wealth Advisors in Bangor, which has more than $200 million in assets under management. He's also the owner of Matthew Thompson LLC, which provides strategic planning services and advice to small businesses, and is a co-owner of Lexi and Matt Photography LLC. Additionally, Mr. Scaves serves as a full-time faculty member in accounting and finance at the University of Maine, or he has served, from 2014 to 2019. Active in his community, he serves on several boards and committees, including the Maine Seacoast Mission, John Baptist Memorial High School, and Robinson Ballet. I'll move forward with the text of the proposed resolution. That the Board of Trustees, acting through the Investment Committee, approves the appointment of Matthew Scaves to a 3-year term as a non-voting, non-trustee member of the Investment Committee, effective in the fall, on the Fall Investment Committee meeting date scheduled for September 16, 2021. Do I have a motion?
So moved.
So moved by Chair Irwin,
Second,
second by, who is that?
the other Jim.
Oh, the other Jim. I'm having a hard time with voice recognition. There we go. Seconded by Trustee Donnelly. And Ellen, I'll pass it over to you for the vote.
Certainly. Trustee Bartholomew,
Yes.
trustee Donnelly,
Yes.
trustee Irwin,
Yes.
trustee Gardner,
Yes.
trustee Martin.
Yes.
The motion is carried.
Great. We're definitely very thankful for the service of Peter Handy and Eric Hayward, and I look forward to working with Jim Bradley and Matt Scaves in the near future. So moving on to tab 5. And tab 5, let me just,
Trustee Martin, just so the committee knows who they are, Matt and Jim are present with us today, so welcome.
I don't want to put you guys on the spot, but do you have anything to say?
Thank you for letting me join.
Thanks for joining us. We look forward to working with you.
And Jim, we needed a pilot, so we're glad you're here.
I'll echo Jim and say, it's a pleasure to be able to serve with you all. I look forward to it.
Thank you. We are definitely looking forward to working with you. I'll move forward to tab 5, and I'm going to turn the meeting over to either Mike or Barry for the defined contribution plan review.
Yeah, great. This is Mike. Thanks. And Barry's here as well. We're just going to do a little bit of a tag team in the presentation to hopefully keep it interesting. And good morning, everyone. And Peter and Eric, thanks for all your insight over the years, and welcome to the new members as well. We're really looking forward to your insight and, hopefully just a continuous improvement of the humane system plan. I'm going to start on page 7. Would you, I'm not sure, do you want me to share my screen? Is that the easiest way to do it, Tracy or Kelly? Okay, yep.
That'd be great. Thank you.
Okay, thanks. So I'll go ahead and share my screen. Okay, and then maybe just one more nod that everyone can see that, okay. All right, thank you. All right, so should be a pretty straightforward quarterly review. We do have one fund change recommendation that we're going to be making today. So I've volunteered to hand that over to Barry. I talk about all the funds that do really well and then let Barry talk about funds that underperform. But I did want to start with just some brief information on things that are going on in the defined contribution marketplace. We used to, for people who used to be on, who've been on the committee for a while, we used to refer these as topical spotlights. Now we're calling them industry updates, but I won't go into a lot of detail on these. One thing that we try to do a prep call, or I should say we do a prep call with Kelly and Tracy before every meeting and try to address some of the topical spotlights in more detail. Cybersecurity is one of those areas where we're seeing a lot more attention, and I think appropriately so. The DOL has released some guidelines for plan sponsors to follow to make sure that they're following good cybersecure practices. And that's great. Again, humane system, I actually believe, has always been ahead of the curve on this. We already have a meeting scheduled with the head of cybersecurity from TIA to discuss their practices. We have no real concerns about TIA's practices. In fact, I think one of the advantages to being with TIA as a leader in the record keeping space is that cybersecurity is absolutely one of their top priorities as an organization. And so we're doing, just as a kind of a good, thorough, prudent fiduciary process, going to be having a separate meeting just to talk about their cybersecurity practices and to document their cybersecurity practices as well. But again, I do want to emphasize that we really don't have any concerns about their practices at all. In fact, we would argue that TIA is as good, probably better than the vast majority of the of the record keepers. There are some participant issues, not issues. Again, there are some participant topics that we wanted to focus on just in terms of account registration, monitoring, updating contact information, things like that. But again, we'll be dealing with that as a separate meeting. And then page 5 really goes through some of the details of the DOL cybersecurity tips, again, that I think for members of this committee may be interesting to read through, but I do want to emphasize those are things that we'll be addressing as in a separate meeting, just specifically focused on cybersecurity. I'm going to skip over page 12 and just, page 6 and go quickly to page 7. Sorry, I get my page numbers mixed up with the board package, but page 13, which is just a quick fiduciary update. And again, these are some DOL guidelines that have been set around missing participant guidance, and then also just some best practices for dealing with missing participants. We're actually seeing this becoming more and more of an issue in the defined contribution world. I think it's largely tied to all of the auto features, which I am a huge advocate. I certainly know that the UMaine system and everyone at CapTrust advocates for some of these auto features like auto enrollment, auto escalation. These are all, things that I think have a meaningful impact on people's retirement plans. But what ends up happening is that in this digital world of auto features and e-delivery, sometimes people don't check their accounts on a regular basis, and sometimes people leave the university without any type of forwarding address. And then what happens is those become missing participant accounts. Again, UMaine, I know, already follows a process with these missing participant accounts. TIA does a good job with missing participant accounts as well. But the DOL has provided, again, some updates on what plan sponsors should be doing. And then finally on page 7 at the bottom, page 13, excuse me, at the bottom, you can see that last year we talked a lot about kind of DOL guidance and some regulations related to ESG investing specifically and proxy voting. Those two issues, which we talked a lot about last year in the new administration, have kind of become non-enforcement issues. So we'll continue to follow the guidelines around ESG investing specifically. And I know the UMaine system continues to follow guidelines around proxy voting that TIA has a really good process with as well. But again, just some brief updates there, because I do know that that's something that we've talked about in the past.
Hey, Mike.
And then finally, before, yes, please.
Is there any way you could, I think it's right in the middle of the page, but blow up your screen just a tad more for those of us with challenging vision?
Yeah, absolutely. And
I appreciate that. Thank you.
Fall into that.
We're all thinking it, I think.
Okay. Is that better?
That's perfect.
Okay. So the next page 14, again, we do a formal fiduciary training. We try to get it to any, new members of committees in the form of a Brainshark presentation. And again, this is something that the DOL has provided more guidance around and is becoming more of an audit topic as well. So in addition to that regular Brainshark training that we do, we also like to just incorporate into our quarterly review packets a slide on fiduciary training. So we basically incorporate one slide from the fiduciary training into each of the quarterly review packets. And essentially, what that shows from a process perspective, and specifically a good sound fiduciary process, is that fiduciary training is something that's ongoing. It's not done just every year or 2 years or whatever that time frame may be. It's something that is done on an ongoing basis. And while we acknowledge and always clear that your plan is not subject to ERISA, I know there's a lot of ERISA language in here. Public plans not subject to ERISA, but the university has always chosen to follow ERISA standards and ERISA guidelines just as a best practice. And so that's why we still refer to that language, and you still, fiduciaries should follow that just as, good stewards of the plan as well. So again, just another update there, which we try to incorporate into each quarterly review. Any questions on those kind of market update, on any of the updates before I shift to markets? So I'll go through the market update relatively quickly, but as you can see on page 16 at a high level here, suffice to say, the first quarter was another strong quarter coming off what was turned out to be a remarkable year in 2020. And the first quarter has started off very strong as well, which certainly quite a bit of volatility as we've experienced, especially over the last couple of weeks. But you can see that through the close of the first quarter, 331, U.S. stocks as measured by the S&P 500 up 6%, a little over. International equities up a little over 3.5%. And really, the one weak area from a performance perspective is bonds and what has been a rising interest rate environment. The aggregate bond index down about 3.5% on a year-to-date basis. Your bond fund is kind of right in line with the aggregate bond index. It tends to be focused on longer durations, which are more interest rate sensitive. And really, again, overall, a very, very strong first quarter of 2021. I wanted to spend most of my time on the markets on this page, though, and just talk a little bit about some of the dynamics that are going on beneath the surface of the market. So I think when you look at certainly the type of positive numbers that we've seen on a year-to-date basis, I mentioned first quarter, the S&P 500 through Friday is actually up over 11%, actually just under 12% on a year-to-date basis. So certainly been a very, very good, first part of the year in 2021. But this page shows, again, it gets a little bit more granular, some of the things that we're seeing beneath the surface. And as we talked about towards the tail end of the fourth quarter of 2020, when we started to see the market rotate back to value, you can see as of the close of the first quarter 21, that value rotation has certainly continued to take shape and perhaps take hold for a period of time. The last 2 years, really 2019 and 2020, the consistent theme that we talked about was this growth orientation of the market. The more growth you were willing to take as more risk you were willing to take as an investor, the more growth that you really focused on as a manager, the more you were rewarded, especially in the area of technology and specifically big technology stocks. That rotation has really occurred more to this value orientation. And you can see through the first quarter, the leading asset class was small cap value at 21%, mid and large at 13 and 11 respectively. And you can see growth really lagged behind significantly. So again, we've really seen this rotation. I bring this up because it is certainly indicative of things that were going on with the market and the economy, but also when Barry starts to talk about the funds in your plan specifically, and either some of the underperformance perhaps on a short-term basis of some of your funds, or the outperformance of some of your funds, generally speaking, it's going to be kind of the leanings of the manager, whether they're a value leaning or growth leaning manager. In addition to that, the fund that he's talking about replacing in a few minutes as well, again, this kind of market rotation certainly has had an impact on that, and our specific perspective on that as well. But this to me is one of, if we had to pick just one of the market slides, I think this is the most important, because down here, it really shows you what's going on beneath the surface. And then up here, certainly interest rates, which really is the foundation of almost all things economic. You can see while short-term rates continue to stay low, the Fed really committed to keeping those short-term rates low. You can see really significant jump in the 10-year Treasury yield from last year at this, or at the close of the quarter, at 70 basis points to over 170 basis points, which is really a significant jump. Great news, I'm sure, when you start to look at the funding ratios of pension plans and things like that. But the impact on your plan from a participant perspective is really, again, I mentioned that impact that rise in interest rates have on bond funds, particularly intermediate and longer duration bond funds as well. No concerns there at all, I should point out. But again, just wanted to point out kind of that interest rate movement. The next several slides digs into a lot more detail about some of the performance across the different sectors. As you can see here, largely, obviously, very, very positive across each one of the sectors, both on a year-to-date basis and certainly over the last year. And then in terms of just our brief forward-looking perspective on things, we break it down into tailwinds and headwinds. Tailwinds, things that we suggest are going to have a positive impact on the market and hopefully the overall economy. Headwinds being things that have a potential negative impact. Certainly from a tailwind perspective, it's all about the vaccine development, distribution, hopefully, the increased numbers of people getting vaccinated and the decrease in the COVID cases throughout the state and hopefully nationwide. That's obviously important for obvious reasons, obviously, health reasons first and foremost. But in addition to that, as we've mentioned many, many times in the past, the US economy is 70% driven by consumers, consumer spending, a huge factor in the US economy. And if you look at kind of the stimulus programs, which have done a really good job stabilizing the economy, boosting the markets, the other thing that it's created is about $2 trillion in extra savings that are out there in the pockets of American people right now. That $2 trillion in large part also represents this kind of pent up spending that, we believe is going, and a lot of people believe is going to occur, already has to a degree, as the economy starts to reopen in earnest. We're certainly seeing that in the state of Maine. I'm certainly, getting that impression as we start to go out to restaurants, and so it's certainly good to see that. And that type of consumer spending, that $2 trillion in savings, if a chunk of that just gets poured back into the economy, certainly going to have a very positive effect. And so, in general, I will tell you, that we are very cautiously optimistic. We do expect continued volatility like we've seen, but we're certainly optimistic, as the economy starts to open in earnest and as people start to get out and spend that, $2 trillion plus in extra savings. From a headwind perspective, again, obviously the top bullet being the virus and variants, and any type of spike could obviously turn things around pretty quickly. Inflation fears is something that you certainly can't turn on any type of financial program without hearing some conversation about inflation. We're certainly see inflation. Inflation, we think, from our perspective, we think we're going to see a relatively short-term spike in inflation, and then we're going to see things settle back down. We also look at longer-term inflation numbers and try to look at, averages as opposed to just snapshots. So inflation is certainly something that we're keeping an eye on, but not something that we're overly concerned about right now. Same thing I would say with rising interest rates as well. Again, I think that, if you look at the positives, the things that will positively impact the markets and the economy, from our perspective, they certainly seem to outweigh those potential negatives. So the next several slides, I won't spend a lot of time on, but they really dig into more detail on kind of each one of those economic bullet points, if you will. And we've wrapped things up just talking about, kind of the potential long-term impact of some of these stimulus programs, the impact on GDP, the ultimate longer-term impact on the US economy, when we have to start, really paying down some of that debt as well. So that's on page 17. But, the takeaway, I would say, from an overall economic perspective, is certainly very positive for the coming months, with, again, expected volatility, but overall very, very positive. And so with that, I'm going to pause for a moment and see if there's any questions at all from anything that I covered so far before I turn it over to Barry to talk specifically about the UMaine plan, Maine system plan.
Mike, just
Okay, so
good
Barry,
presentation. And quick question for you. I'm just curious on your insight, like I seem to ask every meeting, but talk to us just a little bit about what your perspective on the supply chain disruption will be. And it seems to be very real, and it seems to be significant. It will, in times, hamper growth, it feels like, with the demand for everything supply dramatically.
Yeah, I completely agree. And, on a personal note, we're experiencing that firsthand. We're actually in the process of building a home. And it's amazing to me that we're being told that we need to, we haven't even had the foundation or the slab poured yet. And we're being told we need to think about ordering our appliances today because they're likely not going to be able to see them until the fall. Looking at, in addition to the supply chain, which has been an issue, again, this is just using personal anecdotes. The cost of building materials is actually staggering as well. Everything from lumber to concrete to rebar, we're seeing more expensive. That we do expect to settle down. That type of inflation, I think, it really is going to settle down. part of that is tied to the supply chain as well. We've had some pretty unique events that have impacted the supply chain over the last couple months as well. But again, that's one of the frustrations here, is that, you know, we're in a situation where there is this $2 trillion of money that's out there waiting to be spent, and we could and are frankly facing issues with supply chain management and being able to, you know, get some of those goods, you know, that people want to buy. In addition to that, you know, in Maine specifically and overall, there's also the issue around kind of worker supply chain, if you will,
Yeah.
which is, you know, the fact that we just can't find. I think when you look at you know, certainly places like Acadia National Park this summer, you know, that rely so much on kind of students from abroad working at places like that. That type of worker supply chain, you know, again, anecdotally, and what I'm seeing from friends that own businesses, has really created a huge problem. So again, that's the rub. And I agree. I think it's a really, really good point. And I think that it's going to potentially have a, you know, kind of a mute what could be an incredible economic recovery.
And so when you put that in the lens of our portfolios we have here at the system, we're anticipating either the growth side of that or the stagnation of growth because of these disruptions. You think we're adequately positioned for that?
Yeah, I do. You know, it's a great question, and I think it's always interesting for this committee, you know, where you're kind of you're dealing with the defined contribution plan and then moving to other kind of trustee directed asset plans. Because on the defined contribution side, what we really focus on is, do you have the proper participant choice available within the plan? And, you know, when you look at, and Barry's going to share the screen, but he usually starts right on the kind of the snapshot of the fund lineup. If you look at the snapshot of the UMaine system fund lineup, I would continue to argue that it's very well structured, and we think it's well structured during all different types of economic periods. So you have really everything from what I consider to be kind of the foundation of your plan still, which is that TIA traditional, which is a fixed account in this environment that pays a 3% guaranteed rate in-plan liquidity at a time when people are nervous about equity markets. People are nervous about bond markets in the short term as well. You have that foundation, but I think more importantly, you have this wide array of, you know, both actively and passively managed funds that span, you know, from essentially the more conservative large cap all the way to the more aggressive emerging markets and real estate. And again, another foundation of your plan being those Vanguard target date funds. We really focus from a participant perspective of making sure that they have the proper choice, the proper amount of choice, and then having participants focus on long-term investment strategies, you know, based on how far they have to go till retirement. And again, I think that, you know, in terms of the structure of your portfolio, I would say absolutely there's certainly what we would view as no gaps. There's very little overlap. You know, where the overlap occurs, it's generally in that active passive area, not because, you know, there's too many choices in any one asset class. So long-winded answer to your question is, yeah, I think that the portfolio is very well structured for really all economic conditions.
The other thing I would add to that is just inertia. I mean, I think with defined contribution plans, you know, less than 2 or 3% of participants actively make decisions over the course of the year. So when you start to focus on long-term performance, most participants tend to ignore kind of the short-term noise, which ultimately is probably a good thing, that they're not making a knee-jerk reaction like selling on March 23rd and then taking a big hit and then not benefiting the market resurgence. So we do think inertia on these types of plans is really it works to our favor in a lot of times.
Okay, and so Barry, I'll turn it over to you if you want to take control of the screen.
Okay. Can you see this all right?
Yes.
Yes.
All right, let me just I want to move to page 29. We'll start with page 28, and this just really reiterates the question or the commentary we just talked about in terms of offering participants choice. You know, the balance that we're trying to achieve here is we offer participants enough of an opportunity to create a portfolio of their own choosing, but not offering so many choices that they get confused and where should they go. You know, that's why we spent a lot of time 4 or 5 years ago in looking at target date funds, selecting the Vanguard target date funds, is really that set it and forget it, do it for me type of structures, to where those participants kind of career to retirement don't necessarily, for those that are not interested, don't necessarily have to make active decisions. They made that one decision, go to the target date funds, and those target date funds become less aggressive over time. Your plan continues to grow. It's funny, you know, every time I look at this quarterly review, I think about when we were probably about $1 billion when we were, you know, first starting working with the University of Maine system. And since we were hired, we've increased value 800 million. So it's totally on us. Unless the market goes down, then it's not on us. But really just really strong growth if you think about kind of post-recessionary period. I mean, you all that are in the plan kind of look at your balance periodically, and it really is amazing to see the growth we've had since the 2008-2009 period of time. Again, you know, we're just trying to show you the assets where we are, and I'll try and make this a little bigger for those anticipate the question. Yeah, what we're trying to do is just trying to get a sense for where participants are putting their assets. You'll notice about a fourth of the way down, you'll see the Vanguard target date funds. I can't get it all on the page here. The Vanguard Target Retirement Series now has over 13% of the assets. Again, incrementally, as new participants join the plan, they tend to go into the Vanguard target date funds. Not a lot of assets, but when you look at participants, we have certainly more than 13% of the participants in the Vanguard target date funds. CREF stocks, TIA Traditional is still the largest single holding, which is the second line down here. Over $500 million in TIA Traditional, about 28% of the assets. And then if you go a little farther down, you can see CREF stock, about 15% of the assets. And for those that have been with TIA for a period of time, they used to really sell those two funds, you know, having access to a fixed account and have access to a multi-stock fund, both domestic and international. And over time, those numbers come down, but it still represents a significant portion of many of your, especially longer tenured participants. The one fund we're going to talk about is a Carillon Eagle Small Cap Growth Fund. If you see my little cursor here, about $5.9 million, a little less than a third of 1% of the assets in that particular fund that we're going to talk about here in a moment. And I'm going to move to page, bear with me. I'm going to move to page 52. So look away from the screen if you have vertigo, right? One more page. Okay. As you know, for those that are new, this is really just a scoring system that we use to start the conversation. It is not meant to be prescriptive to where if you score, if the fund scores a certain score, then we must take action on it. It's simply just a basis for having some discussion on a particular fund. Mike talked a little bit about the interest rate environment. You know, PGIM, Total Return Bond Fund, high conviction name for us. It's actually scoring a 77. The primary reason for that is this particular fund thought interest rates went too high too quickly. And so they adjusted their portfolio based on that. And so for the first quarter, they had a really, really challenging time. They've come back a little bit since that point in time. But it's just when you look at the volatility in one particular quarter, which is again the first quarter of 2021, because of this volatility, that particular quarter's underperformance caused this fund to actually score as a marked for review. Again, we have no issues with this fund. They're going to periodically, managers are going to make bets based on the current market. This particular bet didn't pan out in the short term, but it is a fund that, again, we still have high conviction for. It's just a matter of this particular quarter. They made a bet where they thought interest rates were going too high too quickly and adjusted their portfolio. Unfortunately, it was not to the benefit of investors. Again, other than that, we continue to have conviction over that, and participants that want to go into a more traditional fixed income offering with the Vanguard Total Bond Market Fund, which is really a US based type of bond market fund. You can see other funds in 99, scoring to 100, 97s. Again, one of the things we try and do is not be so prescriptive that we're making a lot of changes in your fund menu. I know we had to make a couple changes last quarter, and thinking that Carillon, which is the fund we're going to talk about here today, this particular manager, we were encouraged in 2020, it actually outperformed its index. However, when you look at the manager against its peers, this manager has a valuation sensitivity, as Mike had described. In a period that had extreme volatility, 2020, for the most part, you were rewarded for taking on more risk. For those managers that were less valuation sensitive, they did really, really well. So Carillon, we would expect that they would have underperformed their peers, which they did in 2020. However, when the market started reversing, Mike was talking about kind of towards the latter part of 2020 and first quarter, and really carried through even this past week, we've seen more valuations come into play, value side of the equation, more valuation conscious types of managers actually have started to outperform. However, Carillon hasn't. And we don't want to make knee-jerk reactions on particular funds. They're going to have bad periods of time. But this particular manager, I think we've been talking about this manager on and off for the last probably year and a half. And this particular quarter, this particular manager just unfortunately was about 5% off its benchmark on a quarterly basis. And to a point where we were thinking this manager would have improved based on valuations coming more into play. And this particular manager, it just did not pan out. So we are more concerned about this particular manager not being able to navigate. Their stock selection was really poor in the first quarter. So consequently, we are going to make a recommendation to replace this particular fund. I'm going to go to that in a moment after we finish this, the quarterly review. Vanguard target date, again, we made a decision 5 or so years ago on Vanguard target date funds. Again, they continue to do well, a very low cost opportunity, a very well allocated portfolio for participants to go in that want really us to do it for them. We also have all the index offerings. And again, index offerings, it's kind of a pass fail. As long as you have low tracking error and low fees, you're going to pass our policy guidelines. And clearly Vanguard is well established in that particular area. So other than the Carillon Fund and the PJM Total Return Bond Fund, I'll stop there before I move to Carillon to talk about a replacement. So if there's any questions on the review before I move on to that section.
Any questions for Barry? So we're all set, Barry.
Okay, let's move then. We're going to move to page 104. Well, as we have talked about in the past, when there is a fund that fails policy guidelines, we are coming to the table We'll always show you multiple options, but we will also provide you with our recommendation for a replacement of a fund. We're actually showing you 3 different funds here. You'll notice the Carillon Eagle Small Cap Growth Fund on the left, and its various attributes: Principal Small Cap Growth Fund, Mass Mutual Select Small Cap Growth Fund, and Loomis Sales. One of the things that we're ultimately recommending the Mass Mutual Select Small Cap Growth Fund, and don't let the name be a little bit of a misnomer here. Both Mass Mutual and Principal Small Cap Growth are manager of managers. So for example, the Mass Mutual Select Small Cap Growth Fund, 40% of this fund is managed by Oppenheimer/Invesco. 60% is managed by Wellington in 2 different strategies, both a Wellington Small Cap Opportunities Fund and a Wellington Small Cap Growth Fund. So it's kind of a manager of managers approach. We like that in small cap because of the volatility, because of the consistency of change within small cap. We do like having managers that are doing perhaps some different things. One of the managers, Oppenheimer, is a little less valuation sensitive, whereas one of the Wellington funds is a little more blendish. So they provide a good kind of balance to a portfolio. Principal Small Cap Growth, same kind of message. It's actually managed by 4 managers. That would be AllianceBernstein, Brown Advisory, Emerald Asset Management, and then they have about 11% of this fund managed by Principal in an index strategy. So one of the things you will notice is, I'm going to make this a little bit smaller so you can see it on the whole page here, is that they have over 1,200 securities. That's because that 11% that's managed by Principal is in an index strategy. So with an index, obviously they have a lot of particular holdings to that fund. But when you look at performance, you look at Mass Mutual, you look at both quarterly performance, 1 year, 3 year, 5 year, 10-year performance, outperformance to the current fund that we have, Carillon. You go to some of the calendar year performance, you'll also notice the same thing on a calendar year basis. You can see, 2018 is a period that we do concentrate on down markets. When you look at a down market, this particular manager, Mass Mutual, was down 4% when the market was down about 9%, and Carillon was down about 10%. So it's been able to protect on the downside. So when you look at these 3 funds, we will say that it's kind of a 1A, 1B. Mass Mutual, we give a slight lean, better quarterly performance. I looked at year-to-date performance through yesterday, and the Mass Mutual fund is creating a little bit of a gap with Principal more recently. And so when we look at these, all things being equal, our lean is to the Mass Mutual fund. Again, consistent performance, been able to navigate in up as well as down markets. And just frankly, we think a better approach in a very pretty volatile asset class. So that would be our recommendation, is the Mass Mutual Select Small Cap Growth Fund. Again, to level set again, we're talking $5.9 million in the Carillon Eagle Small Cap Growth Fund. If the trustees did accept this proposal, we would work on a queue with TIAA, and they would send out a notification 30 days in advance. And if the participants make no action, both accumulations in this fund as well as future contributions would go into the Mass Mutual Select Small Cap Growth Fund. We were just disappointed. I would say we were disappointed. We were expecting Carillon to actually do quite well this particular quarter, and it was unfortunate.
Any questions for Barry and the recommendation?
Sure. I guess my only question would be, could you talk to the specific things that led you to the Mass Mutual, the Loomis Sales and Principal?
Yeah, when we looked at these, again, these are both high conviction. So when we go through our screens, we're going to show you what we think are our top conviction names. So that's why we call it kind of a 1A, 1B. The slight lean, when you look at Mass Mutual, They're taking on slightly less risk from a standard deviation perspective. When you look at the number of holdings, we like it to be a little more nimble. I know it's a little bit of a misnomer with the index strategy with Principal, but having, we think, a 270 holdings is a very manageable group. The manager tenure, he's been here a little bit longer than the Principal Small Cap Growth Fund. So we have a little bit more manager tenure that's gone back almost 2 decades. And when we looked at more recent performance, MassMutual has seemed to stem the tide even a little bit better than Principal during this really volatile 2021 season. So those are really, again, these are slight leans, but at the same time, that would be our recommendation.
Great, thanks.
And just to get a little bit, kind of more high level, whenever we're recommending terminating a fund like we are with Carillon Eagle, then we go through a formal search and selection process. So we have about 75 people in our investment research group. They do the search and selection process. They follow a very, formal procedure. They start, if you think of it as a funnel, they start, and at the top of the funnel is all small cap growth funds that are on the market. And then they go through a whole series of quantitative screens. The next level would be small cap growth funds that are available on the TIA platform. And then you go through all of the quantitative things, as Barry mentioned, like manager tenure, expenses, assets under management, and until we get down to a series of qualitative screens. The qualitative screens are really where then our investment team gets together and talks about, okay, what are our highest conviction choices in this space? And then it gets all the way down to the UMaine system plan, which is looking at the fund lineup of the UMaine system plan and thinking, okay, what are the best choices that we think make sense in the context of the fund lineup for the system plan? And again, that's where, as Barry mentioned, we get to often 2 or 3 choices, all of which we think are very, very good choices, but we think ultimately it makes sense to make one clear recommendation. And, again, you could choose any one of these 3, and we think that they would be good choices. But MassMutual, as Barry mentioned, has some of the attributes that we're really looking for.
And by the way, it's not lost on us that we're looking at a fund as of March 31st that's up 80%, and we're recommending we replace it, which is just, get your head around that one. That's why it's relative performance, relative to benchmarks, relative to peers, et cetera.
Barry, I had a question. I wondered if you could speak to the expense ratio on that. Actually, all 3 of the alternatives are higher than the Carillon fund. I recognize they're smaller than the universe average there, but can you speak to that jump in the expense ratio and whether that is worth or part of your consideration?
No, thank you for bringing that up. We do look at expense. Obviously, any more expense is less return in the participant's pocket. So we are very much acutely aware of expense. When we look at the universe average, the universe average is obviously over 1%. The particular managers, if you would chart them, you would be certainly in the bottom 50% in terms of fees, so competitiveness of fees. So that's good. The other thing I will say there, when you have multiple managers, there is a little bit added expense when you have multiple managers within a particular fund strategy that may add a little bit to the expense, but at the same time, it's still less than kind of the average for the marketplace and in line with other funds that we've seen. So yes, we don't necessarily like it that it's almost a little over 20 basis points more expensive, but considering the performance is net of expense, we think that is not a high hurdle rate.
Great, thanks.
Yep, great question.
Any other questions, comments? Hearing none. This is agenda item number 6, and we have a vote on this. So I'm going to read the text of the proposed resolution. That the Board of Trustees, acting through the Investment Committee, approves the recommendation of CapTrust to terminate Carillon Eagle Small Cap Growth Fund, replacing the fund and mapping the assets and contributions to Mass Mutual Select Small Cap Growth Fund. Do I have a motion?
So moved.
So moved by Vice Chair Gardner.
Second.
By Trustee Donnelly. And Ellen, please take a roll call.
Mike, could you stop sharing your screen for a moment?
Oh, that's me, sorry.
Great, thank you. Trustee Bartholomew,
Yes.
Trustee Donnelly,
Yes.
Trustee Irwin,
Yes.
Trustee Gardner,
Yes.
Trustee Martin.
Yes,
The motion is carried.
great. I'd like to thank Mike Pratico and Barry Schmidt for the review on the defined contribution plan and for bringing us through the change of the small cap growth fund. And moving on, I'm going to turn the meeting over to Kelly Regan and Jay Roney of NEPC, and they're going to go through the performance reviews of the management investment pool, defined benefit pension, and the operating fund portfolios.
Thanks, everyone.
Take
Good
care.
morning, everyone. It's good to be with you today. I'm Kelly Regan, and Jay's video just popped on. Kelly, it looks like you would like us to share our screen, which we're happy to do so. Is that correct?
Yes.
Okay, great. So let me orient myself here. Okay. Can you all see my screen?
Yes, I can. Everybody
Okay,
else?
great.
Yep.
Yes.
Go right ahead, Kel.
Okay, great. So to start our prepared remarks, I'm going to have Jay Roney go through a short market update. We understand you just met with Cap Trust, and I'm sure they gave a market update as well, and then we'll move into your portfolio's performance. So I'll turn it over to Jay now.
Great. Good morning, and thank you, Kelly, for that introduction. If we turn to page 115, which you already have, Kelly, I'll just quickly review the markets. And I'm only going to look at 3 specific pages, and then we'll turn it over really to the bread and butter of the review, which is the performance of the 3 pools of assets. But as you can see on page 115, the markets really reacted positively on the back of real strong economic news during the quarter. You saw great returns coming out of equities, and you can see some of the benchmarks in the upper right-hand quadrant of this page, with US markets doing better than international and emerging. What was very interesting, if you peel back a couple layers of the onion, or the equity market onion, you do see that value stocks continued to do better than growth during the first quarter. And we saw kind of the glimpse of that, in the fourth quarter of last year. And that really benefits diversified programs and strategies such as the ones that you've implemented with your pools of assets. So we're very excited about that. Along with that economic growth that we saw really during the first quarter, typically comes higher interest rates. And we did see those as evidenced in the lower left-hand quadrant, of the chart here. Conservative strategies that typically have a high allocation to treasuries did poorly as those interest rates rose, and you see the US aggregate down 3.4%. At the same time, you saw credit spreads compress, which is good for asset valuations, and you see the high yield market up about 80 basis points. And of course, we saw commodities appreciate. You see oil up 22.4, as well as everybody's, I'm sure, read some articles about how crazy the lumber market has been more recently as well. Kelly, if we turn to page 116, I do want to just take a look at some of the raw numbers. The data that you see on page 116 is data as of March 31st. I'm actually going to bring you forward through the end of April. And again, I'm only going to cover 5 indices. But if you look at the year-to-date column all the way to the right, I'll kind of update you through the month of April. If you look at the S&P 500, again, the first row, you see year-to-date up 6.2. That's actually 11.8 through the month of April. If you go down to the EFI index, which is about 4 rows down, which is the developed international index, you see that says up 3.5. It's actually up 6.6. And not to be left out, the emerging markets index, just 1 down, up 2.3 is actually up 4.8. We saw interest rates during the month of April actually slide a little bit. So we saw some positive numbers coming out of the fixed income markets in April, but we still see some negatives on a year-to-date basis. If you go down to the aggregate index, which Kelly has highlighted, down negative 3.4, it's actually down 2.6. In the high yield index, just above that, is actually up 1.9% year-to-date basis. So again, even though at some points diversified strategies don't add value on all occasions, we do see the benefits of that coming through strongly today. The last page I'll look at is page 118. And this just shows you how interest rates have moved during the quarter and how, in particular, they've risen during this 3-month time period. The green line represents the Treasury yield curve as of the end of the year, and the blue represents the same curve as of the end of the first quarter. You see there wasn't much movement in the short end of the curve and a tremendous amount in the intermediate and long end of the curve. In fact, if you look at that 10-year rate, at the end of the year, it was probably around 80 basis points. And just a scant 3 months later, it was about 1.75 or so. So again, that brings short-term pain from an asset perspective, but it really sets up the portfolio to do nicely in the future. Again, if you're earning higher yields on your portfolio, your assets should do better over the long run. One thing that we have to be cognizant when we look at this yield curve is that we are still grounded at really the 0% yield in the short end of the curve. And that has a negative effect on your operating cash pool. You've got about 34% of your assets in that short end of the curve. So that does mute returns in that operating cash pool. So what I'm going to do at this point in time is take a pause, see if there's any questions. But everybody's probably more interested in learning about how the portfolio has performed over the last quarter and over the last year. If there's no questions, Kelly, I believe the floor might be yours.
Okay, great. Thanks, Jay.
Thank you.
I'm going to turn to page 121 and start with some comments on the managed investment pool, or the MIP, as we call it by acronym. Just to start talking about assets and asset allocation, you can see here in the top left, we have a pie chart with how the managed investment pool is allocated across a number of different asset classes, both equity and fixed income. And you can see plan assets were a little over 423 million at the end of March. And this is roughly almost 11 million increase since the beginning of the year. So a very strong quarter in asset gains for the portfolio. When you think about asset allocation, when we think about the approved investment policy statement, everything is in line and in compliance with that statement. So no significant deviations from your policy targets. Performance is up here in the top right. The composite is the MIP's actual performance over the different time periods, and it is net of manager fees. So you can see for the quarter, up a little over 2%. Fiscal year to date, which your fiscal year to date starts July 1st, up almost 21%. So it's been a strong fiscal year for the managed investment pool. And then you can see the trailing 1-year number up almost 38%. And this is really just showing the remarkable recovery that we've seen. It goes from April 1st, 2020 through March 31st, 2021. So that's really kind of the rebound from the initial stages of the pandemic. You can see some strong results, and then longer term, some strong positive returns. A couple things to note when we think about the recent quarter's performance. One of the things that we do is we evaluate your managers to see in aggregate if they've added value above the benchmark. That benchmark is the allocation index, which is an index of passive benchmarks to your asset allocation. And you can see over the quarter some value detraction from your managers. And we'll go through specifically some of those managers, but at a high level, managers that had exposure to small cap and to value, and specifically to financials and energy sectors, did quite well during the quarter. But then a number of managers that are more focused on momentum or high quality growth, or had some of exposure to technology, which ran up really well in 2020, was hurt a little bit in the first quarter. And some of those managers did underperform their benchmarks during the quarter. Over the fiscal year to date, in 1 year time period, you can see that manager underperformance did occur, but on a much smaller scale than the recent quarter. We also look at the managed investment pool versus peers. So other endowments and foundations of similar size of 105 to 500 million. And we show the rankings down here for your plan. 1 is the best, 100 is the worst. You can see for the most recent quarter falling short of median, which is the 50th percentile, ranking in about the bottom quartile. Part of the reason for that during this quarter is other peers do have allocations to private equity, which is up about 10% during the recent quarter. And this portfolio does not have that exposure. So part of it was asset allocation decisions that detracted. But you can see, as we've spoken about at the past meetings, your fiscal year to date and your 1 year rankings have improved over the longer term rankings. And we still see some positive rankings there at or above median. Today, we have no recommendations on this portfolio and a couple of manager updates, but nothing, they're all no action, nothing of material to make decisions on, just more of a for your information. Moving on to the pension fund, we have about 25 million in the pension fund. And when we look quarter over quarter, assets have remained relatively stable. They did decline about $1 million, and that was really due to benefit payments of around $350,000 that are paid out monthly. So $1 million decline in assets just because of benefit payments. And you'll see over here on the right, the composite, pretty flat returns for the pension fund. So no investment gains during this quarter. When we think about asset allocation, it's in line with your investment policy statement. And you can see how the allocation is here. We have a good majority of assets, around 30% in global equity, with one manager, Walter Scott, which manages to the US equity markets, international developed and emerging market equities, and then a sizable portion of the portfolio in core fixed income. And this is one of the reasons why the returns for the portfolio are slightly negative, is just because we did see those rising bond yields, which put pressure on about a quarter of the portfolio. Again, we manage this portfolio to be more conservative in nature, just because of those high cash outflows that we see for benefit payments as a portion of your total assets. So this portfolio is more conservative than the managed investment pool. Looking at performance, as I mentioned, flat for the quarter and falling short of the allocation index by about 150 basis points. And all of this is really due to one manager, your global equity manager, Walter Scott, and we'll go into their performance shortly, but it is one of your high quality growth managers, which was not rewarded during this first quarter of 2021. Over the fiscal year to date time period, again, starting July 1, you can see some strong fiscal year results. The target return or expected return on assets for this portfolio it is 6.25. So you've well achieved that so far. I would expect April results to be positive for the pension fund, as all indices were positive during the month of April. So that has probably ticked up a little bit if we rolled this forward a month. And then over the last 1 year, up almost 20%, which is a very strong return for a more conservative managed portfolio, and longer term results meeting around that 6.25 target return. No recommendations that we're going to make today on this portfolio. Moving on to the operating fund. We have assets of around 307 million. This is up about 25 million since last quarter. We typically see sizable inflows into the operating fund in the months of January and September, really around the time of tuition payments. So assets did increase over the quarter because of inflows. You can see the asset allocation here. We show it in terms of pools. We have a liquidity pool of around 35%, which is all money market funds. An income pool of around 47%, which is more of fixed income. And then your total return pool around 22%, which is more equities, managers such as global asset allocation managers that can invest in equities. So a little bit more return generating from that pool. And when we think about that asset allocation versus your policy statement, you're within guidelines. We are a little bit overweight to the income pool today because of the cash inflow, a little bit underweight to the, a little bit overweight to the liquidity pool because of the cash inflow, and a little bit underweight to the income pool at this point. And throughout the rest of the year will be, payments will be pulled out of the liquidity pool to fund necessary cash needs throughout the year. In terms of fund performance, you can see the pool was up about 60 basis points for the quarter. Fiscal year to date, up a little over 6%, which is above the 4% targeted return. So fiscal year to date has been off to a good start. And then over the last 1 year, up almost 12%. Again, this is a pool with about 35% in cash assets. So the income pool and the return generating pool did add significant value over the 1 year time period. When we look at this pool's managers and you compare the composite versus allocation index, you can see some manager outperformance in aggregate, about 20 basis points for the quarter and about 3% over the trailing year. So managers in this pool have been doing well. We have some fixed income managers that have been overweight credit, which has added value, and some of your return generating managers have been doing well versus benchmarks. Today, later in our presentation, we will have a recommendation. We are recommending that you consider replacing one of your credit managers, Loomis Sayles Bank Loans, in this portfolio with a bank loan manager that you use in the managed investment pool in the pension fund, which is Bain. And we'll walk you through that analysis later on today. Before I walk through some of the managers, I just want to stop and see if there's any questions on top line performance for the three portfolios. Okay, hearing none, we're going to start with the managed investment pool managers. A lot of these managers are in the pension fund. So we'll start with this portfolio to walk you through a lot of the same comments for this portfolio as the pension fund, given the overlap of the managers. Just thinking about the recent quarter, this is the column in the middle here. So that's the first quarter results. I mentioned earlier that small cap did well. Cyclical sectors did well. Managers with exposure to financials and energy did well. And you can see when we start looking at your active managers, Westfield and DFA. Both managers did well during the quarter. You can see the value manager, DFA, up almost 25%. During the quarter, as value did bounce back, but both managers did outperform their benchmarks during the quarter, and longer term results versus peers and benchmark continued to be strong. You can see these ranking numbers next to the managers over the last 10 years, both are around median when we think about them versus peers. I mentioned that Walter Scott, your global equity manager that you've had in place for about a little bit less than a year now, did underperform during the quarter. Still some strong positive results for the fiscal year to date time period, but really you can see that's fallen short because of the quarter underperformance of about 4%. Again, very high quality manager, focused on high quality growth, and with some of that value rotation, they did underperform a benchmark that encompasses both value and growth. This is something that we would expect in this type of market environment. But as more normal market environments exist, they do have a little bit of value and growth in their portfolio, and have done well over long term. We have seen this manager do particularly well when markets are down as they do have some good downside protection. So in an up market, underperformance is expected. For both Morgan Stanley and J.O. Hambro down here, they are your two international equity developed managers. Both did underperform during the quarter. Morgan Stanley is a core international equity manager that does tilt a little bit more value, but more value in the sense that they're more defensive value. And as we've seen a run up in more cyclical value, they did underperform during the quarter. Longer term results are more strong. Again, no concerns with their performance, but some of that defensive positioning that they have did not bounce back in this recent quarter. And then J.O. Hambro, again, is a newer manager in your portfolio. They had a great 2020. They do invest in value, growth, momentum, and quality. And the momentum part of their portfolio, those stocks that did really well in 2020, did not continue to do well. That momentum factor did not exist in the first quarter of 2021. And that was the reasoning for their underperformance. And when we look at the international equity universe, I think the stat, something like only 10% of managers that outperformed in 2020 continue to outperform in the first quarter. So again, not alone, other international equity managers experience a similar type of phenomenon. Kabouter is the manager here that when we look at them versus their benchmark, they had most of the deviation versus the benchmark. This manager is very focused on high quality earnings, not really a value growth type of tilt, but more of a high quality tilt. And those stocks that, didn't have earnings, think lower quality in nature, performed quite well in the first quarter. And Kabouter is still sticking to their investment process. That's not an area that they're going to invest in. And so this is most likely a short-term deviation in performance. And it's not something that's concerning at this time. It is, however, driving down longer-term performance versus benchmarks. One manager, Kabouter, in the first quarter of 2020 had significant outperformance. So again, a manager similar to Walter Scott, where they're going to protect more on the downside and not participate as much on the upside. You have two emerging equity managers, Aberdeen and Mondrian. You can see Mondrian did quite well for the quarter on an absolute basis, up almost 6% versus Aberdeen, which was up almost 2%. And that's that small cap factor that really benefited Mondrian during the quarter. So similar here in the US, small cap did well. It did well in emerging markets as well. You can see from that perspective, Mondrian ranks around the top quartile versus other emerging market peers, given that small cap bent to their portfolio, even though they did underperform their benchmark that was up about 7.7% during the quarter. Again, Mondrian is very focused on high quality investing. They use their dividend discount model, and that fell short of the strong benchmark during the quarter. Again, another manager that tends to protect more on the downside. And then Aberdeen, some short underperformance here. Again, more high quality emerging market equity manager. So I think the theme that you're hearing here is small cap and value has done well, but managers with a really high quality bent, focused on high quality earnings, did lag during the quarter given the market dynamics. Moving on to fixed income and alternatives. You can see for the quarter here, some negative results for Common Fund, which is your active core fixed income manager. The longer dated tips down about 1.4%, but outperforming core bonds during the time period, given the Treasury and inflation focus. And then some positive performance from shorter term tips. BlackRock, which is a diversified credit strategy, was able to eke out some returns, some positive returns when the broad fixed income market was down. And then Bain is your bank loan manager, which continues to do well, adding value above the benchmark and ranking well versus peers. So very diversified fixed income portfolio. Overall, when you look at your total fixed income, it was down about 80 basis points during the quarter. where again, the broad Barclays aggregate was down about 3.4%. So having that diversification in fixed income did help during the quarter and protect some of your assets versus a benchmark. Newton is your sole global asset allocation manager. Positive performance during the quarter, has been in the portfolio now for a little over 3 years. And you can see some strong absolute results from Newton, up 8.5 over the last 3 years. Again, a manager that's very diversified across global equities and global fixed income. And when we think about this manager versus other global asset allocation managers, and you think about rankings, over the last 3 years, they've ranked 20. So in the top quartile of other managers. So they've done very well for you over the last 3 years. And then Lighthouse is your long short equity manager. They tend to have very low net equity exposure. So when markets were up, they were down a little bit here, down 1%. They tend to protect capital in down markets. Their long positions did very well during the quarter, but they did have some negative detraction from their short positions. This is a long short manager. But over the long term, you can see that they've added value above their benchmark over all time periods and have ranked, around median over the last 3 and 5 years. So no concerns over the recent performance. Still one of our top tier long short equity managers. And then Landmark is your private equity manager. Again, this manager will be most likely just distributing capital over the next few years, as all capital has really been called. You'll see for the quarter, we have 0 here. That's just because the valuations haven't been received yet, versus that benchmark of 13%. So when I was talking earlier about rankings, for those portfolios that have a more sizable private equity position, your peers, they would experience some of this 13% gain, where this portfolio has about 0.5% exposure to it, and then the valuations weren't received for this quarter. Longer term, you can see positive 10% over the last 5 years. Again, this is on a time-weighted basis. On an IRR basis, which we typically evaluate private equity managers, that is much higher. I think it's around 11 or 12%. I'm going to skip over the pension fund. All the managers in this fund are the same as the managed investment pool. So again, very similar comments that I just walked through. Again, the majority of the negative return that you saw during the quarter was because of this fixed income portfolio, which was down about 2% during the quarter. There is one manager in the pension fund that is not in the managed investment pool. So I'll stop here and talk about Principal, which is one of your real estate managers, and it's in the portfolio to help generate some income for the portfolio. So like a fixed income alternative, not correlated with fixed income assets and equity assets. And you can see the performance for the quarter added value to your portfolio. And then over the longer term, up 4 to anywhere from 10% over the last 10 years. So again, has added value into this portfolio over all time periods. Moving on to the operating fund. There are some different managers in the operating fund, so I'll spend a little bit of time here. Up in the liquidity pool, we have a mix of 4 strategies. The state pool, which has the majority of the assets, has a little bit more higher yield than money market funds. But as you can see with performance, certainly it is experiencing those low rates because of the Federal Reserve's actions to keep rates around 0. And then 2 money market funds, Federated and JP Morgan, which are pretty much earning 0 over the recent time periods, given where rates are on the short end. Within your income pool, this is a diversified mix of managers. You have Income Research and Management, which is focused on short-term credit and treasuries. You can see pretty flat over the quarter, as so was the benchmark. Longer term, this manager has done well and added value over the benchmark. They tend to overweight credit and underweight government securities. And as credit spreads have fallen, specifically over the past year, that has added value over the benchmark. I spoke about BlackRock earlier. Again, diversified credit manager, think high yield, emerging market debt, other investment grade type assets that has done well over the fiscal year, and really the trailing 1 year as we've seen credit spreads fall. It's been over 14%. A manager that we'll talk about in a few moments is Loomis Sayles, a bank loan manager. For the quarter and fiscal year to date time period in 1 year, they've been in line with the benchmark, but you can see longer term performance has fallen short. And when we compare this manager to Bain, which is your other bank loan manager in the other two portfolios, Bain has done quite a lot better than Loomis Sayles, and we think it would be a good opportunity to have Bain across all three portfolios as your bank loan manager. But we'll talk a little bit more about that. And then down in the total return pool, it's more conservative. So it is total return versus fixed income and cash, but it's not very aggressive. So we have Lighthouse, long short equity manager, two global asset allocation managers, Newton, which we've already spoken about, and then PIMCO All Asset, which is a manager that invests in equities, fixed income, and other types of real assets. Think of commodities and tips and other types of real asset exposure. They've done particularly well over the quarter and over the fiscal year and 1 year time periods. Their exposure to emerging market equities, specifically emerging market small cap equities, has done well. They do have exposure to commodities, which bounced back in the first quarter. Earlier in 2020, they did have exposure to longer dated treasuries, which when we did see falling yields, that added value to their portfolio. So they've really had their positioning right and really have, you can see that in their performance, they really benefited from it. And then lastly, just an equity index, the Vanguard World Stock Index, which is a global equity index that invests in US, international, and emerging. And as you can see, it would be expected from an index. They're right in line with their benchmark. So I will stop here and see if there's any questions on the portfolio, any of the managers, any of my comments.
Any questions for Kelly?
Maybe just a point, Kelly. And that is we because of the nature of these portfolios being a bit more downside protective, that's why we haven't enjoyed some of the upside in some ways. And that's why a fair amount of our fund managers are below that 50% benchmark and the 0 to 100 score. Is that accurate?
That is accurate. I think your absolute results have been very strong over the fiscal year and 1 year time period. But when you look at, deviations from benchmarks, I think that high quality focus, you do have a mix of managers that focus on downside protection. Again, they're going to participate in this market rally, but they're not going to be outperforming significantly versus a benchmark during this market rally.
Kelly?
Yeah.
During this, I'd say the last 4 or 5 years, we've been pretty cautious and had some really nice downside protection. In the rearview mirror, does it look like we've been too cautious and given up some of the upside by doing so?
Sure. So it's hard to, kind of call that, but a lot of, and if I take a step back into history, after 2008, there was sensitivity to what happened to the portfolios and that down market that we saw in 2008. And as we started to change managers throughout the years and focus on, on that, there has been a tendency to, when we present search books, present manager options to the group, there has been more of the tendency of, let's focus on downside protection. Let's try to avoid what happened in 2008, be a little bit more conservative in nature, still want to be able to achieve our stated return goals, which I think you have for all three portfolios, which is being very mindful of risk. And that's just been a theme across the group over the last, 10 plus years.
Well, clarity of what's happened is always, an unfair judgment. But from the lessons of that, would you be advising us to take more risk, to that the strategy meets our goals. It sounds like that's what you're saying. I just want to kind of get some clarity around that for some of the newer members and refresh some of the older members on the committee.
Sure. I wouldn't, we wouldn't be advising to take more risk in terms of switching to very aggressive type managers at this point in time. We think the managers you have in place are all solid. Over the last few years, though, we have been working with the group to diversify those risks a little bit. So the portfolios were even more focused on value and downside protection. And over the last couple of years, we did try to work on portfolio construction to maybe slightly increase risk by having some growth in the portfolio. So having a little bit more well-balanced portfolio, but again, not super aggressive and not something we would recommend at this time.
Hey, Jim, this is Jay. Just to work off of Kelly's comments, you know, I'd focus on two items. One, I agree with Kelly, the actions that have been taken in the last couple of years have built better portfolios that should work during, or portions of it should work during any market environment going forward. So there's a better balance of managers and their philosophies that go into that. If you were to look at the portfolios, you know, it's hard to say that we should be more aggressive or less aggressive as kind of a broad comment, as you do have three portfolios that have distinct goals and objectives that are quite different, you know, from each other. To give you an example, the operating pool, there's a tremendous amount of cash flows that go out to pay for your operating expenses during the course of the year. And we want to make sure there's not huge drawdowns on there because of the reliance that the system has on that pool of assets. I'd also mention, and Kelly kind of shortchanges this a little bit, even though we have talked about it, you know, over the last decade. But Kelly, if you turn to page 132, you kind of see from a pension perspective, and I realize it's the smallest pool of assets that we have, but almost 15% of the corpus goes out of the portfolio on an annual basis based upon the benefit obligations that the system has to the pensioners that are out there. So if you did want to get more aggressive, I would think that you wouldn't want to do that in the operating pool. You would not want to do that in the pension pool. But if there was an opportunity, maybe that MIP would be the place to do it. And we've spoken on numerous occasions to the committee in regards to private equity and other types of investments, which could boost returns. And kind of, even though there's fruitful discussions on those topics, the decision is made not to go down those roads. So we're happy to have those conversations again with the group. But we think that that the portfolios are properly positioned based upon your goals and objectives and the views of the committee members, at least when we spoke to them last. Any comments, Jim? I'll pause.
Yeah, I only challenge it because I think there's lessons to be learned from what you've done but the environment we're going into is different than the one we're coming out of. So you can't just plop them over. I think the turbulence and what's going to be in the next 12 or 18 months, maybe we're perfectly positioned right now, but just kind of teasing out some opinion from you and some thoughts for the committee.
Yeah, I'd guess without getting in trouble, Kelly might kick me under the table if we were in the same room. The future is always uncertain. You know, I've been a consultant for 21 years. And prior to that, I was a plan sponsor overseeing, you know, billion-dollar corporations, pension plans, and 401k plans. Regardless of what market environment, there's always the boogeyman under the bed that everybody's always worried about. And we have those today. We had those 2 years ago. We had those 5 years ago. We had those 10 years ago, even though the last decade has been an amazing, you know, investment time period. That said, at NEPC, we're comfortable with ramping up risk as long as committee members, as long as it fits your goals and objectives, as well as there's a comfort level with the committee members. Because when you start going down a road of being more aggressive, it's not for the faint of heart sometimes based upon the volatility that people see. So we'd hate people to reverse directions at market lows, and that's a destruction of value strategy that a lot of people employ if they don't stick with it. So again, we look forward to working with the committee to figuring out what the right volatility levels are. We think they're great right now, and we think they're going to meet your goals and objectives, but we're always willing to listen. And I will say, Jim, your comment on lessons learned didn't fall on deaf ears, and those lessons Kelly and I have been implementing over the last year, 2 years, improving the portfolio from an investment manager structure, getting that more diversification, trying to pare back on having all managers being downside protection. So you see a good balance of growth and value in the portfolios now. I'll pause. Kelly, I hope I didn't get you in trouble there.
No, that was great. Good context on the 3 portfolios, Jay. Thank you. Any other questions from the committee? Okay, I think the next section, sorry, I'm flipping through here to get there. It's already it's on page 220. We're going to talk about asset allocation, which I think will kind of feed off your question and some of Jay's comments. And again, this section is not to have any recommendations for the committee, but to really show you the asset allocation of the 3 portfolios. We did, talk about it when we're going through performance, but put it into perspective of forward-looking expectations. We do our quarterly assumptions at NAPC on a quarterly basis. And so we have our March 31st assumptions, which we're going to show you. And really the purpose is to show you the 3 portfolios because in the month of June and July, we work with Tracy and her team to really put these expected return numbers into a letter for your actuary for the purpose of showing that we can meet your stated return goals. So that's the purpose of this presentation. It's just really more of an update, but I think it'll be helpful with that recent question. So over here on the overview page really just states what I just said. We're not recommending any changes. It's really just to illustrate the expected returns on a go-forward basis that we think the portfolios can achieve. When we think about looking forward and some of NAPC's views on portfolios, you'll see our expected returns are lower. And that is, we've come out of a number of years with great equity markets. We have very low fixed income yields. So again, our expected returns for asset classes have come down. When we think about portfolio construction, we think it's very important to have what we call a safe haven allocation to provide downside protection if we continue to see a wide range of outcomes really coming out of this pandemic. We think all 3 portfolios have that exposure today. It varying degrees based on the goals and objectives of the 3 portfolios. One area is that we do think is advisable to take some risk is having higher strategic equity targets. However, for the 3 portfolios, based on what we've heard from your goals and objectives, we think the equity allocations are in line and do help already support those return goals. I'm just going to stop here on page 221 just to really show you the 10-year returns for all the different asset classes. Again, these are beta only, so what we think passive indices can get you, such as the S&P 500 over the next 10 years, kind of versus where they were about a year and a half ago when we last ran these for you. And what you can see is really across the board, the delta, all asset classes are really down in terms of what we think you can expect over the next 10 years for different equity, fixed income, real asset, and multi-asset asset classes. For example, large cap equity, we're expecting 5% over the next 10 years with some premium if you do invest outside of the US, such as in the EFI markets, non-US developed. Emerging market equity from our perspective has the highest return potential. It certainly comes with additional risk or volatility. You can see that at about 7.4. And then private equity, again, taking that illiquidity risk gives you a potential 9% return. Again, these are all median expectations, a base case expectation over the next 10 years. And then within fixed income, you can see quite muted returns here. Treasury yields are low, so 1.6% return there. High yield, you certainly get a little bit more return from the spread component there, but spreads are at all-time lows, about 3% there. So not a lot of places to really achieve those returns unless you're really to take illiquidity risk within private equity, private debt, and other private asset classes. That being said, when we start looking at the MIPS asset allocation, today you have about 60% in total equity as your target. So a good exposure to equity, coupled with exposure to fixed income at 26%, and then some diversifying assets at 14.5%. And even within this hedge fund allocation at 7%, that is equity exposure. So you do have a good amount of equity exposure in this portfolio, diversified across different manager types and styles, different regional asset classes, different capitalization. And what this means for the next 10 years and 30 years for this portfolio as we look forward, you can see the return expectations are anywhere from 5 to 6%. So again, lower than in the past. You can see the volatility, the standard deviations around 12%. So when we look at other portfolios, this is the portfolio that takes a little bit more risk than the others at 12%, but still a moderate risk level. And then when we're thinking about supporting the return goal of 7.25, we have over here that our analysis can support that return goal. And part of that reason is when we think about expected returns, this portfolio is invested into perpetuity. So we really use that 30-year expected return of 6.1. But because there are volatilities in portfolios, we tend to put a range around expected returns, and we tend to look at one standard deviation ranges. So we really think from a range perspective over the next 30 years, anywhere from 6.1 to 7.2 is a range that we can use to support your expected return. And I said earlier that these are beta only. So this is just what the market can give you from our assumption perspective. Managers are supposed to add value over a long period of time. We think that your active managers over the next few years can have an alpha of about 50 basis points in aggregate. So when you put all those metrics together, we think the range of returns can be 6.6 to 7.7. So your 7.2 falls right in the middle of that. And we think we can continue to support that return goal with the asset allocation in place. Because of that, with some of my earlier comments where I don't think we need to take a lot more risk in this portfolio, but certainly happy to have more discussions with you if some views have changed. For the pension fund, similarly, that I just went through, we think we can, for the MIP, we think we can support the pension funds return goal of 6.25. You can see this portfolio has less equities than the MIP at 33%, a lot more fixed income than the MIP at 43%, and then some diversifying assets such as that principal fund and core real estate and some global asset allocation strategies. So again, more conservative than the MIP. You can see that with the standard deviation of 8.5, so a lot lower than the 12 that we just walked through for the MIP. And then with this, we think over the next 30 years, again, the pension fund still has a long-term horizon as benefit payments will be paid out for quite a long period of time. They'll certainly come down in terms of total level of payment that will be paid out, given the nature of the fund. But over the next 30 years, we think that the range of returns could be 5.4 to 6.1. And similarly as the MIP, we think that there can be alpha from your managers around 50 basis points. So with that, the range of expected returns would be 5.6 to 6.6, and your 6.25 falls right in the middle of that. So we think we continue to support the return goal with the asset allocation in place for the pension fund. And then lastly, for the operating fund, most conservative portfolio, you can see that with the standard deviation at 3.9 based on our volatility estimates. Again, 30% in cash for your target, over 45% in fixed income, and just a small portion, less than a quarter of the fund, in return generating assets. And again, very conservative return generating assets. With that, over the next 30 years, we think a range of returns could be 3.9 to 4.2 for this portfolio, which is actually quite impressive from a Sharpe ratio perspective. They just think return divided by standard deviation. Those numbers are all similar. So if we have a 1 standard deviation downside event, this portfolio should hold up pretty well. And then 30 basis points of manager value add in this portfolio is expected. Again, not so much in active managers, and those active managers that we do have, a lot of them are in fixed income. So you don't expect as much alpha from fixed income as you do from equity. So the alpha assumption for this portfolio is lower. That being said, 4.2 to 4.5 is the range of returns that we think we can support. And your return target is 4%. So certainly can support that return goal. So I'll just stop there and see if there's any questions. Again, this was just to show you your current asset allocation, our expectations for risk and return for them, and how we can support your return goals for actuarial purposes this year.
Any questions? Any questions for Kelly or Jay?
Yeah, this is Mark Gardner. I have a quick question, Kelly or Jay. And I think I ask this almost every time I review this. Can you remind, these are all net of fees returns, correct?
These are beta only. So think about, these are our NAPC's expectations for what the market can give you. And then you would have, so if you were passively invested, those fees would be, very low. When you performance of your portfolios, they are net of any manager fees that you pay. So
when you reference I was going back to the MIP, when you reference 7.2% being achievable, that's net of, we should think of that against the MIP as being net of fees or before fees.
That's what you should try to achieve, net of fees. So,
okay.
Yeah, your actual portfolio returns.
Right, the actual return. Okay. Because these are all projections off beta, as you said. So.
Correct.
Thank you.
You're welcome. Kelly, if there's no other questions, would you like me to turn into the recommendation?
Yes, definitely.
Okay. So I alluded to this a little bit earlier when I was going through performance. I mentioned you have 2 bank loan managers across the 3 portfolios. So in the MIP and the pension, you use Bain. You hired them in 2018. You have about 20 million with them in the MIP and about a little over $1 million with them in the pension. And then in the operating fund, you've had Loomis sales for about 14 years, since 2007. And you have assets of about 18.5 million with Loomis sales. Back in 2018, when we were looking for a bank loan manager for the MIP and the pension, we did evaluate hiring Loomis sales for the MIP and pension, but through interview process and partly because returns looked great, volatility looked great for Bain, but they do also incorporate ESG. So there was a little bit of a tilt to hire them in the MIP and pension at that point in time. There was no concerns with Loomis sales, so we didn't decide to terminate them out of the operating fund back in 2018. But as Jay and I have continued to monitor the portfolio and performance of these 2 managers, and we show that at the bottom of the page here, you can see that Bain has done much better than Loomis over all time periods, and really by a significant amount. And again, these performance numbers are net of fees. When you think about product AUM, some qualitative or quantitative statistics for the managers, both managers have sizable product AUM. You do get a higher yield out of Bain, 5.2 versus Loomis, a 3.1. Similar duration, again, very low duration managers as we're working in a floating rate environment. So low duration for both managers. And part of the reason why you get a little bit of a yield uptick is just a little bit lower quality in Bain than Loomis, but not significantly, and similar fees. So we think, with Bain's performance, the way that they've performed over Loomis Sales, the fact that Loomis Sales has underperformed the broad bank loan universe or benchmark over all time periods, we think, making a portfolio adjustment and bringing in Bain and replacing Loomis Sales in the operating fund can be beneficial to the operating fund. That's the recommendation that we have for you today. So again, it would be to terminate Loomis Sales for about 18.5 million in the operating fund and hiring Bain for the operating fund at that amount.
Any questions in regards to the recommendation?
No question, Kelly, just a comment that it makes a lot of sense. The yield is far greater. The annual fees are in line. And their average quality of Loomis is a BB rating, which Bain is a B. And just to refresh my memory, Kelly, a B is actually a better grade, correct?
No, the double B would be a better grade.
It's so we're getting a lower graded, okay.
A little bit. And Loomis Sales is very high quality. So they, really in that double B space. Bain operates more in the B space. They do have a little bit of more flexibility in their product, where they can have a little bit of high yield in their product if the spread environment and the opportunity is conducive for that. So a little bit more flexibility with Bain, a little bit slightly lower average quality, which gets you that yield pickup.
Any other questions? Okay. Well, thanks, Jay and Kelly, for the very informative review of the performance and the asset allocation, and also for the review of our action item number 9, which there's too much paper here. Hold on a second here. There it is. I'll read the text of the resolution of our next action item and our final one, that the Board of Trustees, acting through the Investment Committee, approves the following investment manager change. Replace the Loomis Sales Bank Loan Strategy with Bain Bank Loan Strategy in the operating fund. Do I have a motion?
Moved.
So moved by Trustee Donnelly. Second?
Second.
Seconded by Trustee Gardner. And any discussion, any questions? Hearing none, I'll pass it to Ellen for the roll call vote.
Certainly. Trustee Bartholomew,
Yes.
Trustee Donnelly,
Yes.
Trustee Irwin,
Yes.
Trustee Gardner,
Yes.
Trustee Martin.
Yes.
The motion is carried.
Well, we're at the end of our meeting. Well, thanks for all your time and all the contribution in the meeting. We have a wonderful weather week ahead of us. It looks like we're coming out of winter really nicely here. So go on and enjoy the week. Thanks so much for your time today.
Thank you, everyone.
Thank you.
Thank you.